past few years, buying a car felt nearly impossible. Prices were sky high, inventory was scarce, and dealers held all the power. But everything has changed, and not in the way most people expected. Dealerships are stuck with unsold cars, automakers are delaying new models, and prices are shifting in ways no one expected. If you make the wrong move now, you could lose thousands, or get the best deal of your life. Volkswagen just hit pause on its electric vehicle lineup. Tesla is making more money from carbon credits than cars. And used car prices? Some are crashing while others are skyrocketing. By the end of this video, you'll know exactly what's happening, what's coming next, and how to use this market shift to your advantage. Let's break it all down. What's happening? For the past few years, buying a car felt like trying to get a front-row ticket to a sold-out concert. Impossible unless you were willing to overpay. Prices skyrocketed due to supply chain disruptions, semiconductor shortages, and increased demand. But now the market is shifting, and not in a way most people expected. Some cars are plummeting in value, while others stubbornly hold their price. If you have been waiting for prices to drop across the board, the truth is more complicated than it seems. The new car market is going through a massive correction. Automakers, eager to cash in on high demand in previous years, overproduced vehicles. Now, as consumer spending tightens and interest rates remain high, those once hot new cars are sitting unsold. Some dealerships are slashing prices to move inventory, leading to massive discounts on slow-selling models. But not all new cars are getting cheaper. Brands like Toyota, Honda, and Subaru, known for their reliability and limited production, are maintaining their value. This divide between high-volume and in-demand models is making the price drop uneven. Meanwhile, the used car market is in chaos. Many expected used car prices to crash after their unprecedented surge. But while some vehicles are getting cheaper, others are still holding strong. Luxury sedans, electric vehicles, and rental fleet cars are seeing steep depreciation as demand drops. However, gas-powered trucks, full-size SUVs, and high-mileage economy cars remain surprisingly expensive. The reason? These vehicles are still in demand among work fleets, budget-conscious buyers, and those skeptical about switching to electric. If you are in the market for a car, understanding this divide is crucial. Buying a luxury sedan or an electric vehicle right now might get you a great deal, but if you need a reliable gas-powered car, the market still favors sellers. The trick is knowing which segment to target and being ready to negotiate when the opportunity arises. Just as used and new cars are experiencing unpredictable shifts, the electric vehicle market is facing its biggest crisis yet. The EV boom just went bust. Automakers promised an all-electric future, so why are they canceling EV production? Just a few years ago, electric vehicles were supposed to be the future of driving. Governments worldwide pushed aggressive regulations to phase out gas-powered cars, and automakers rushed to announce fully electric lineups. It seemed like a done deal. Internal combustion was on its way out, and EVs were taking over. But then, something unexpected happened. The demand did not match the hype, and now automakers are rethinking their strategies. Volkswagen recently announced that it will not introduce any new electric vehicle models in the upcoming year. Instead of accelerating production, they are hitting the brakes. The reason? They simply cannot sell the EVs they have already built. Dealerships are sitting on unsold Volkswagen ID.4 models, and consumers who were once excited about EVs are hesitating. The issues range from high prices and charging infrastructure concerns to battery degradation worries. Volkswagen is not alone in pulling back. Ford has delayed production of its next-generation EVs, citing weak demand. General Motors initially aimed for an aggressive push into electric, but it is now slowing down, even discontinuing the Chevrolet Bolt, a model that was one of the most affordable EVs on the market. Toyota, despite its reputation for hybrid technology, has been notably cautious about fully committing to EVs. Instead, they continue to invest in hybrids and alternative fuels. One of the biggest problems automakers face is consumer reluctance. Many buyers who were excited about electric vehicles have realized that EV ownership is not as seamless as advertised. Charging infrastructure remains inconsistent. Long charging times frustrate users, and cold weather significantly affects battery performance. Additionally, EVs come with a higher upfront cost, and many potential buyers are waiting for prices to drop before making the switch. As a result, dealerships are desperate to move their electric vehicle inventory. Massive discounts, incentives, and lease deals are everywhere, yet sales remain slow. The dream of an all-electric future is facing serious setbacks, and automakers are now scrambling to adjust their long-term plans. While the EV market struggles, another crisis is unfolding inside car dealerships, one that could completely change the way cars are sold. Dealerships are panicking, and here's why. If you walk into a dealership right now, you'll notice something strange. Empty customers, but full lots. For years, car dealerships could not keep enough cars in stock. Vehicles would arrive and immediately sell, sometimes for thousands above sticker price. But in a sudden reversal, lots are now overflowing with unsold inventory. Some dealerships are even running out of space, forcing them to rent additional lots just to store vehicles they cannot sell. This is not just an inconvenience, it is an existential crisis for many dealers. The reason dealerships are panicking is simple. They do not own the cars on their lots. Instead, they rely on a system called floor plan financing, which means they borrow money to keep cars in stock. Every extra day a car sits unsold, the dealer has to pay more in interest and fees. The longer the inventory lingers, the worse their financial situation gets. In extreme cases, some dealerships are losing money just by keeping cars on the lot. Brands like Kia and Nissan, which ramped up production to meet past demand, are now drowning in excess inventory. To move these cars, they are offering steep discounts, manufacturer incentives, and even dealer rebates. However, these discounts only go so far. If consumer confidence is low, buyers will still hesitate. The current dealership crisis is exposing weaknesses in the traditional car selling model. The combination of slowing demand, high financing costs, and excess inventory is creating the perfect storm. This means the next few months could be the most volatile we have seen in the auto market in decades. But what about used cars? If new car dealerships are struggling, does that mean used car prices are crashing too? The answer is not as straightforward as you might think. Why the used car market is a mess right now. If you think all used cars are getting cheaper, you're in for a surprise. The used car market has been on a roller coaster ride for the past few years. Prices surged to all-time highs during the pandemic due to supply shortages and increased demand. Now, as the industry corrects itself, some expected prices to crash, but the reality is more complicated. Some used cars are seeing massive price drops, while others remain stubbornly expensive. Electric vehicles and luxury sedans are experiencing the steepest declines. Models like the Tesla Model 3, BMW 7 Series, and Mercedes-Benz E-Class are depreciating faster than expected. With more EVs entering the used market and buyers hesitant about long-term battery life, dealerships are struggling to move these cars. Similarly, luxury vehicles that were once status symbols are now sitting in lots as consumers opt for more practical and fuel-efficient options. On the other hand, gas-powered trucks, full-size SUVs, and reliable economy cars are still holding value. These vehicles continue to have strong demand among work fleets, rural buyers, and budget-conscious consumers who prioritize durability over luxury. Hybrids, especially Toyota and Honda models, remain in high demand due to their fuel efficiency and reputation for reliability. The biggest factor keeping used car prices unpredictable is interest rates. Even though vehicle prices are dropping in some areas, higher interest rates mean monthly payments are still expensive. This has forced many potential buyers to delay purchasing a vehicle, further slowing the market. The key takeaway: if you are looking to buy a used car, timing is everything. Some vehicles are absolute steals right now, while others are still overpriced. The best deals are on electric vehicles and high-end sedans. But if you are looking for a dependable gas-powered car, you might still have to pay a premium. If you are in the market, knowing when to buy is more important than ever, and not every automaker is surviving the shift. Some companies are thriving, while others are barely hanging on. But what separates the winners from the losers? It all comes down to how they make their money. Let's start with the most surprising example: Tesla. Tesla's dirty secret. How does Tesla stay profitable despite declining sales? The answer has nothing to do with cars. If you think Tesla's success is solely about selling electric vehicles, think again. Tesla's financials tell a very different story, one that reveals just how dependent the company is on sources of income that have nothing to do with making or selling cars. The truth is, Tesla has mastered the art of leveraging government incentives, playing the cryptocurrency market, and profiting from carbon credits, a financial lifeline that has kept the company afloat even as traditional automakers encroach on its EV dominance. One of Tesla's biggest sources of income comes from selling carbon credits. Because Tesla only manufactures electric vehicles, it accumulates regulatory credits from governments that require automakers to meet emissions targets. Companies that don't meet these targets, such as General Motors, Stellantis, and Ford, are forced to buy these credits from Tesla to remain compliant. This isn't a small stream of income. In some years, Tesla has earned over $2 billion from selling these credits. This means a significant portion of Tesla's revenue has nothing to do with its own cars. It's coming from other companies that are paying to offset their emissions. Then there's Tesla's cryptocurrency gamble. In 2021, Tesla made headlines when it invested $1.5 billion into Bitcoin. That investment fluctuated wildly, but at key moments, Tesla strategically sold portions of its holdings, cashing in on Bitcoin price surges. In a single quarter, Tesla recognized a $600 million gain simply from trading Bitcoin, an amount that accounted for a significant percentage of its profits at the time. Beyond that, Tesla makes money in ways that most car companies don't. Its software and self-driving packages are priced as subscription services, bringing in continuous revenue without having to sell new cars. Unlike Ford or Toyota, which rely primarily on car sales and maintenance services, Tesla has been moving toward a business model that mimics a tech company, one that is built around software, licensing, and long-term subscriptions. But here's the problem. What happens if these income sources dry up? If governments reduce carbon credit programs, if Bitcoin crashes again, or if Tesla fails to deliver on its self-driving promises, the company's entire financial structure could be at risk. And this isn't just speculation. Tesla's margins on actual vehicle sales have been shrinking, leading the company to slash prices just to stay competitive. Tesla isn't the only automaker struggling to maintain profitability. Several traditional car manufacturers are facing serious trouble, but for entirely different reasons. Who's on the brink? Some car companies are quietly struggling, and their problems are bigger than you think. The car market is unforgiving. Some automakers are thriving in this new environment, while others are barely surviving. As demand fluctuates, inventory builds up, and competition intensifies. Companies like Volkswagen, Ford, and General Motors are facing major setbacks. Volkswagen, once an aggressive leader in the EV market, has suddenly pulled back. The German automaker recently announced that it would delay all new EV releases until at least 2026, a sign that their electrification strategy is failing. Why? Because they're struggling to sell the EVs they already have. The company is sitting on excess inventory, and price reductions haven't been enough to clear their backlog. Ford is facing a similar challenge. After making massive investments in EV production, the company is now losing tens of thousands of dollars per electric vehicle sold. The Ford Lightning, once seen as the truck that would revolutionize the industry, has seen demand drop sharply, forcing Ford to scale back production and cut prices. Meanwhile, Ford's hybrid lineup remains in high demand, proving that full electrification isn't what consumers are looking for. Then there's General Motors, which has faced setbacks in both its EV and traditional car businesses. The company's ambitious EV rollout has been plagued by delays, battery production issues, and lukewarm consumer interest. At the same time, GM has been slow to adapt to shifting demand, leaving it caught between two markets, one that isn't ready for full electrification and another that still expects affordability. On the other hand, some automakers are thriving despite the downturn. Toyota continues to dominate, largely because it hasn't overcommitted to EVs. Instead, Toyota has focused on hybrids, a segment that continues to grow as buyers look for fuel efficiency without the drawbacks of full electric vehicles. Meanwhile, companies like Hyundai and BMW have successfully balanced their gas-powered, hybrid, and EV offerings, keeping them financially stable even as the market shifts. So, if some brands are struggling and others are thriving, what does this mean for car buyers? It means that some vehicles are becoming massive bargains, while others are financial traps. The cars that are now a bargain, and the ones to avoid. The biggest price drops have been in the electric vehicle and luxury sedan segments. Models like the Ford Mustang Mach-E, Volkswagen ID.4, and Mercedes-Benz EQ series have seen steep declines in value as dealers struggle to move inventory. Similarly, high-end luxury sedans like the BMW 7 Series and Audi A8 have been hit hard, with resale values dropping faster than expected. On the flip side, some vehicles remain incredibly strong investments. Hybrid cars, particularly Toyota models like the Prius and Camry Hybrid, continue to hold value due to their reliability and fuel efficiency. Similarly, used trucks and SUVs from brands like Toyota and Honda are still in high demand, making them more resistant to price drops. So, how do you spot a great deal? Look for cars that have been sitting on lots for extended periods. Dealers will be more desperate to sell them. Avoid vehicles with poor resale value or costly maintenance issues, such as low-demand luxury sedans or first-generation EVs with outdated battery technology. Now that we know which cars are worth buying, the question becomes, should you buy now or is it better to wait? Should you buy now or wait? The biggest question, is now the time to buy? Or will prices keep dropping? Timing your purchase is everything. Right now, the car market is experiencing wild fluctuations, and knowing when to buy can mean the difference between getting a great deal or overpaying. One major factor is tax refund season. Every year, millions of people receive refund checks, which leads to a short-term spike in demand, causing dealers to raise prices temporarily. However, once this rush fades, prices tend to stabilize or even drop again. Another factor is interest rates. As borrowing costs remain high, monthly payments are more expensive than ever. If interest rates come down later this year, financing will become more affordable, making it a better time to buy. So, what does this mean for buyers? If you need a car now, look for long-sitting inventory and negotiate aggressively. But if you can wait a few months, prices may drop further, especially on slower-selling models. If you time it right, you could save thousands. From how people buy vehicles to the very nature of car ownership, everything is shifting. Traditional dealerships are fighting to stay relevant. New technologies are reshaping vehicle powertrains, and the cost of owning a car is rising faster than many consumers realize. But the biggest question remains, what will driving look like in the next decade? The end of the dealership model. As more automakers experiment with similar direct sales strategies, traditional dealerships are feeling the squeeze. Some states have even pushed back against direct sales to protect franchise dealers, but the trend is clear. Manufacturers want to control the sales process, and customers are embracing it. Subscription-based car ownership is another challenge to the traditional dealership model. Instead of buying or leasing, some consumers are opting for car subscriptions that allow them to pay a flat monthly fee to access a fleet of vehicles. Companies like Porsche, Volvo, and even Ford have experimented with these services, which cover insurance, maintenance, and the flexibility to switch between different models. This shift means fewer long-term commitments, which in turn reduces the need for traditional dealerships to act as intermediaries. So, will dealerships survive the next decade? The answer depends on how quickly they adapt. Some are transitioning into service and repair hubs, knowing that maintenance will remain essential. Others are focusing on used car sales, which are less impacted by direct-to-consumer trends. However, the days of massive dealership lots filled with rows of new cars may be numbered. As digital sales and new ownership models take over, traditional dealerships must evolve or risk fading into history. If dealerships are struggling to stay relevant, what about the vehicles themselves? The battle between electric and gas-powered cars is far from over, and the industry is at a major crossroads. Gas versus electric. The debate is over. A few years ago, it seemed inevitable that electric vehicles would replace gas-powered cars. Automakers poured billions into battery technology. Governments pushed aggressive incentives, and environmental groups celebrated what appeared to be the beginning of the end for internal combustion engines. But today, the situation is far more complicated. While electric vehicle adoption is growing, sales have not met expectations. The reality is that hybrid vehicles are outselling full electric cars in key markets as consumers look for alternatives that offer both efficiency and convenience. Toyota, long skeptical of a fully electric transition, has seen tremendous success with its hybrid lineup. And now even automakers that once dismissed hybrids as a temporary solution are reconsidering their strategy. The future of gas-powered cars is also being reshaped by synthetic fuels and alternative power sources. Porsche, for example, is investing heavily in e-fuels, a synthetic gasoline that allows traditional combustion engines to run with lower emissions. Hydrogen fuel cell technology, another alternative, is being developed by companies like Hyundai and Honda, offering a different path toward reducing dependence on gasoline without requiring massive charging infrastructure. While electric vehicles still play a key role in the future of transportation, they are not the universal solution many expected them to be. So, which technology will dominate the future? The answer is likely a mix of all three: hybrids, electric vehicles, and alternative fuels. The global car market is diverse, and different regions will favor different technologies based on infrastructure, government policies, and consumer preferences. The dream of an entirely electric future is now facing resistance, not because of a lack of technological progress, but because people want practical, affordable, and accessible solutions. The next generation of cars won't be fully electric, but they won't be fully gas-powered either. While the battle over vehicle powertrains continues, one thing is clear: owning a car is becoming more expensive, and for many, the hidden costs are adding up fast. The hidden costs of car ownership are rising. Buying a car is just the beginning. The real costs start later. One of the most significant and often overlooked expenses is insurance. Over the past few years, insurance rates have skyrocketed due to a combination of rising repair costs, increased vehicle complexity, and supply chain disruptions. Modern cars, especially electric and luxury vehicles, are packed with advanced sensors and technology that make even minor repairs extremely expensive. A simple bumper replacement that once cost a few $100s can now run into the thousands because of built-in cameras and safety features. Maintenance costs are also climbing, particularly for electric vehicles. While many people assume that electric cars require less maintenance than gas-powered vehicles, the reality is more nuanced. While EVs do not need oil changes, they still require battery replacements, software updates, and specialized repairs that can be costly. Additionally, tire wear is often faster on EVs due to their higher weight and instant torque. On the other hand, gas-powered cars face their own cost challenges, with rising fuel prices and increasingly expensive engine repairs. So, how can car owners avoid these hidden fees? One of the best ways is to research long-term ownership costs before buying. Certain brands like Toyota and Honda have a reputation for reliability and lower maintenance expenses, while others may come with higher than expected costs. Shopping around for insurance discounts and considering extended warranties for specific components can also help reduce financial strain. Ultimately, being an informed buyer is the best way to avoid unnecessary expenses and keep car ownership as affordable as possible. Rising costs are just one piece of the puzzle. The bigger question is, what will car ownership even look like in the next decade? The way we drive is changing, and soon, cars will be more like tech platforms than mechanical machines. The future of driving: self-driving cars, AI-powered assistants, and automated repairs. This isn't science fiction anymore. The way people interact with their cars is evolving at a rapid pace. Artificial intelligence and automation are redefining the driving experience, making vehicles more than just a mode of transportation. Soon, cars will anticipate driver needs, optimize routes in real time, and even perform self-diagnostics to schedule maintenance before problems arise. Modern vehicles already feature adaptive cruise control, lane-keeping assistance, and AI-powered infotainment systems. But in the next decade, these technologies will become even more advanced. Tesla's Autopilot, GM's Super Cruise, and Mercedes-Benz's Level 3 autonomy systems are just the beginning. By 2030, fully autonomous vehicles could become a reality in select cities, reducing the need for human drivers altogether. Meanwhile, advancements in vehicle-to-vehicle communication will allow cars to share real-time data, minimizing traffic congestion and improving road safety. Another major shift is the rise of car subscriptions, which could replace traditional ownership and leasing models. Companies like Volvo and BMW are testing subscription services that allow customers to swap between vehicles, bundle insurance, and avoid long-term commitments. This model offers flexibility, especially for younger consumers who may not want to be tied to a single vehicle for several years. Additionally, as urban mobility evolves, car-sharing platforms and autonomous ride-hailing services may further reduce the need for individual car ownership, reshaping the entire automotive landscape. So, what does this all mean for you? Are you planning to buy a car soon? Or are you waiting for prices to drop even further? Do you think electric vehicles will truly take over? Or will hybrids and alternative fuels win in the end? And most importantly, how do you feel about the possibility of never walking into a dealership again? Let us know in the comments below. We read every response and we want to hear your thoughts.